Welcome to this Killik Explains finance video. This week, not surprisingly, a fairly topical one, why an oil price spike shouldn't spook equity investors. It certainly spooked the oil market, but it shouldn't spook equity investors. Okay, let's take a look at why. Now, the background to this is what? Unless you've had your head in the sand, you will have realised that last weekend there was a high-tech drone strike on a large oil facility in Saudi Arabia. The world's biggest refinery lost millions of barrels of production, and the oil price rose 20% as a result. To put that in context, that's arguably the biggest one-day spike since 1990. It got to over $70 a barrel from closer to $50, almost immediately on Monday morning when the markets opened. So certainly big news in the short term in the oil market. But, and here come the buts. Basically, I'm going to argue there are three reasons why, as equity investors, we can be a little bit sanguine. Now, if there are more strikes, then that might change the picture. But for the time being, we can be sanguine. The world is less oil price sensitive than it used to be. We'll look at that in a moment. The effect on inflation, which some people are worried about. Crikey, hang on a minute. Oil is crucial to the consumer in the form of petrol at the pumps. If you hit the consumer in the pocket, what effect does that have given the consumers driving some of the growth in the West and so on? Well, let's take a look at that in just a moment. And in the stock market, there are actually winners as well as losers. So bad news can be good for certain companies. And that's why the stock market reaction was probably rightly fairly muted. Now, let's look at the first of those arguments. The IEA and UDDE, easy for me to say, report good levels of reserves. Now, you might say they would do, they've got a vested interest in doing so, but actually, it seems as though, big though this strike was, the world will be able, broadly speaking, to absorb the shock from it in supply terms. So basically, the recent spike in the oil price was significant, but it still puts it below the level it was 1 year ago and below the peak in June 2014, with no drone strike apparent at the time. So all we're saying here is that yes, a one-day price move of $20 is massive, but actually in historical context terms, that doesn't take the price up to anything like a scary level, and in terms of its all-time high, still way below anything catastrophic. So bear that in mind. Number two, the oil dependency argument. Well, basically here we're showing, according to BP, global energy demand split across different resources. Now, oil is still pretty chunky, and there's plenty of oil demand around the world. 1/3 of that graph, if you like, is oil, but that tends to grab the headlines, and increasingly the world is putting effort into generating other sources of energy, as that graph clearly shows. And if I was to wind back by decade, if you like, you would see these sort of rising up in importance relative to oil over time. And that's worth bearing in mind. So key factors. Non-OPEC supply is rising, all right? So a hit in Saudi is definitely newsworthy, is problematic. But actually, supply of oil is slowly, one can argue, getting a bit more diversified. Energy efficiency is increasing in developed countries. So in developed countries, demand basically is being contained by the fact that we're getting more efficient. In emerging markets, different story of course, but globally that means our dependence on oil is gradually being reduced, and the rise of alternatives means that oil itself is finding new sources of supply. So for industrial use, you have got some alternatives, albeit some of those alternatives are not massive volume and or tricky in production refining terms. Inflation. So surely a big spike in the oil price will have an effect on inflation. Well, analysts at Citigroup have done some calculations here. A 10% sustained, important word, sustained rise in the oil price could add 0.2% to inflation. So is that scary? Well, fuel and utilities, oil would sit in there in the inflation basket, account for around 6% of the consumer prices index. That's substantial, but it's not a catastrophic amount. In other words, consumers feel the pinch. You fill up your car at the petrol pump, it costs more money, that's painful. The argument goes you'll spend less on other stuff potentially, but actually 6% is not too dramatic, and pay data suggests, perhaps more importantly, that wages are currently outpacing inflation. So even if you add a bit to inflation, consumers should be able to absorb the impact. And the winners and losers argument. So looking at the stock market, who are the winners and losers? Well, there were some clear losers, and these were in the headlines. Airlines, it's unarguably bad news if the oil price goes up. Same for manufacturers, same for haulage firms as a broad category. But for oil giants like BP and Shell, it's actually beneficial to see a rise in the oil price overall, and therefore the impact on developed markets was fairly muted. The impact on local markets much more dramatic, but on developed global markets fairly muted, and that is probably about right. Now all bets are off if drone strikes become a regular pattern in the future, but if this is an isolated incident, markets were probably correct to remain sanguine, investors correct to remain calm. To find out more and to watch other videos around this topic, it's basically editor@killik.com for the queries, and for the videos it's killik.com/learn. And on this side, the investing principles tab and hunt for the oil video.